Currently, inflation is at about 2.7%, and the Fed has set a target rate of 2%. How do you see inflation playing out over the next few years?
A core PCE target of around 2% corresponds with headline inflation a little bit below the 2.7 you mentioned. So we actually think, given what energy prices have done in the last couple of months, headline inflation is coming down and will probably push sub 2% as we head towards the end of the year. But I think core will remain stubbornly high given the sort of structural change that we've seen in the housing markets.
How can Treasury inflation-protected securities, or TIPS, help investors ward off that inflation?
Well, TIPS are specifically designed for fixed income investors as a way to protect against inflation. And when you think you purchase a nominal bond that, take for example, the 10-year note today pays you, gives you a yield of 1.85%. The biggest risk to your 1.85%, if you exclude credit risk for the time being, is you're going to earn a yield of 1.85% for the next 10 years. If inflation is 5%, you're actually going to lose 3.2% on a real basis. And that's what TIPS actually try to eliminate.
What is the best way to determine the total value of a TIP?
If you look at 10-year TIPS, 10-year treasuries, as I mentioned earlier, trading at a yield of 185, if we take the matched maturity 10-year TIP, that trades at a real rate of approximately minus 35 basis points. So that really corresponds to a break-even inflation rate of around 2.2%. So if I look at that, if I think inflation is going to be higher than 2.2% over the next 10 years, I'm going to be in better off position if I purchase the real rate. And if I think it's actually going to be less than that, I would probably be better off owning the nominal rate.
So who should be considering investing in TIPS? Who are they good for?
Again, various points of the curve can serve different purposes. I think from a retail perspective, the individuals, the nearer they are to retirement probably should be skewed towards real rather than nominal rates, because when you're in retirement, you do not have bargaining power over your wages. So if inflation does indeed go up, I grew up in Zimbabwe and I saw my mother's pension payments, on a real basis basically become null and void within a year. So I do believe that if one can own real rates in in retirement, you're probably far better off owning real than nominal.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to